the heart of the investment world. I look at the time value of money as the heart of the investment world. The more you are able to understand the time value of money and the concept of interest, the more you would be able to do the valuation of the financial securities more comfortably, right? So probably it is one single topic of finance which you should develop expertise on, because almost every aspect of finance is driven by this concept in some form or the other, right? It's very simple to understand, but at the same time there is a lot of depth in it, because see, what we see generally is when we talk about any investment, right, the cash flows that come out of that investment, probably we have different cash flows at different points in time. Some of them are outflows, some of them are inflows, but some of them they are known, some of them are unknown. But whatever may be the cash flows, what we know is different amounts and at different points in time. So bringing all those payments and receipts to the common platform, to a common time period, it could be either today or it could be at some future date, but bringing all the payments and the receipts to a common time platform is what is the job of time value of money. How do I make sure that different amounts that are received at different points in time, they are all brought to the same time period? What is the kind of adjustment I can do to their value so as to get them to the same time period? That time period could be today, that time period could be at some future date. That is the concept behind the time value of money application, right? So with that as the base, let's get in. So the base of any time value of money related exercises is the interest. Whenever we take a loan, the bank levies something called interest for us, right? Or whenever we deposit some money in a bank, the bank pays some kind of interest for us. So what do we mean by the interest here? It's simply a fee which might be agreed at the initial time of contract itself. The fee that is paid by the borrower of the capital, borrower of money, to the lender of money for using his money. As simple as that. Whenever we talk about interest, it is nothing but it's a fee that a borrower pays to the lender for using the money of the lender. So sometimes the banks pay deposit to the depositors. The bank is using the money of the depositors for giving some loans and all. So the bank is paying some kind of interest on the deposits that it has received. Similarly, the companies, when they borrow money to do their business operations, they pay to their lenders along with the amount what they have taken as the loan. They pay a fee on the top of it, which is called as an interest. Now, in regarding this interest, for different borrowers, we have different interest rates depending on the payment capacity, the capacity as well as the willingness. After assessing